Today, the Fed is, very focused on, understanding the direct lending market, understanding the private credit market, understanding kind of what is happening outside of the regulated environment. The reality, and we mentioned this when we talked about how the industry accelerated post-financial crisis, a lot of this is of the Fed's own making.
Hello and welcome to the Tuesdays with Morrisey, where we share insights from great thinkers. Today I'm excited to be joined by AV Private Credit's President Brent Humphries and Managing Director Marc Cooper as we continue our mini-series in the alternative asset market. Guys, thanks for coming on the show.
Absolutely. Looking forward to it.
I'm excited to have a conversation about the boom we've seen in private credit, a sector of the finance ecosystem that's experienced a lot of growth over the last 10 years. Some stats to kick it off. The AUM within private credit firms have grown from roughly $500 billion to $2 trillion over the last 10 years. So to lay the foundation for the conversation, I wanted to start with a little private credit 101. How do you explain private credit to somebody who might not be familiar with the term?
Wonderful. So I'll take that, and I guess maybe we'll define it very specifically. What Marc and I do at AB Private Credit Investors is we're in a segment of private credit that I'll refer to as direct lending. So private credit encompasses a number of different asset classes, everything from specialty finance, real estate credit, real asset lending, so where you're lending against vessels, rail cars, etc. But then you also have an element which is private corporate credit. And so that's where we focus. And as a direct lender, we're basically sourcing and originating opportunities directly from either private equity firms, principally, or from companies themselves. And that concept of direct origination effectively means we are typically disintermediating the traditional financial institutions or banks. Our focus is on partnering with leading private equity firms. And in simple terms for the audience, we're making private loans to private businesses that banks typically don't make today. And they have a hard time making. And we're pulling capital from sophisticated investors, institutional investors, and high net worth investors, pulling that capital in funds, and then we're lending that out and really providing the liquidity and the financing lubrication to really drive the growth in the private equity market.
And, from what I've heard in the past about private credit, there's a couple of reasons why somebody might do it. Private credit firms can generally move faster than, a traditional bank. Another one I've heard is maybe it's an industry that, traditional banks stay away from. And then third would be liquidity requirements. Maybe there's other reasons or related to business why, somebody would go out and get private credit. Are you seeing that changing over time to being just, kind of just the preferred vehicle for lending?
Yeah, well, I think this kind of touches on sort of what's driven the growth, the really tremendous growth that you've seen over the last decade or so. And specifically within direct lending, there's 3 or 4 key factors, one of which is bank regulation coming out of the great financial crisis, which impacted, banks' ability to basically hold these loans and lever the businesses as they need to be levered. I think the second key factor is there was an innovation at the same time in space that the quote unquote unitranche structure came into play. And, essentially prior to the unitranche structure, a lot of private equity buyouts were financed with a combination of bank financing and mezzanine capital. And to put that type of deal together, it takes a lot of time and effort. And so private lenders are able to offer sort of speed, certainty in execution, and an ability to do, different kinds of structures that are tailored to sponsors' needs.
That fact that we're not regulated, as Marc mentioned, it allows us to be much more flexible, to tailor solutions that are customized for a particular borrower's needs, to move much more quickly. So a lot of the things that you mentioned, Adam, at the outset of the question, and I really think it has become the preferred solution, in particular for middle market private equity firms or middle market companies. And we're going to define that for this purpose as 10 to 75 million of EBITDA. Once you get beyond 75, 100 million of EBITDA, borrowers and private equity firms have other avenues. They can look at the broadly syndicated loan market. They can look at the high yield market. They can also go to the direct lending market And increasingly, even in the upper larger market, they are choosing direct lending, but there's more competition from those other segments than there is in the core middle market. In the core middle market, I would go as far as say we rarely compete with banks today, and the direct lending or the private solution and that unitranche solution Marc referred to is really the financing vehicle of choice or structure of choice.
Yeah, I mean, if you look at the market share, it's completely flipped on its head over the last 10 to 15 years, where banks basically originated 75% of leverage loans. Today, banks originate 25%, and direct lenders are originating about 75%.
And Brent, you've been, part of AB in Austin since 2014. Can you talk a little bit about the customer education journey that you saw, particularly probably in the first 5 years of your tender? Because it seems like since, about COVID time, private credit's all anybody talks about.
Yeah, so I'll go back even farther. So I started in the direct lending private credit space in the early 2000s. And I think that's really when the industry started. And specifically, that's when you started to see this evolution of the unitranche product. So now with the unitranche product, with direct lenders, at the time I was with Goldman Sachs, there were a handful of other lenders that were doing this back in that time frame. Once an alternative credit manager had the ability to hold a revolver and to provide the traditional senior secured bank tranche, now we do it as part of one single lien, single tranche vehicle that goes from the first dollar to the last dollar of leverage. So we're underwriting typically through that second lien or mezz piece, what historically would have been that junior capital. We're just providing a single solution. And that's really when the asset class started and really evolved. Now, there was an acceleration of growth post the financial crisis. So, post the financial crisis, 2008, you saw a significant growth in the asset class. And that's because, as part of Dodd-Frank, to address concerns about systematic risk, the regulators effectively made it tougher for banks to make these types of loans to private companies, made it more expensive for them to hold the loans on balance sheet, and really, in some respects, encouraged the growth of this industry because it's taken the risk lending to private companies out of the regulated banking environment where you have, bringing into play FDIC assured deposits, et cetera. I don't think has been a major education process in the last 5 years to the private equity firms that are taking our capital, because they've kind of seen they've seen the development since 2004. And in our case, when I started my career, I think the education is probably a little longer than the last 5 years. It probably goes back to 2009, 10, 11. The education really started with the investors, the LPs, the investors in the space. And at the time, early in the evolution of this asset class, this wasn't a formal asset class. It was kind of, where do you source it? Do you source it from your private equity allocation? Do you source it from fixed income? There was no formal private credit asset class really that was in existence within pension funds, endowments, or an individual's portfolio. So there's been a lot of education among the investor base over the last 10, 12 years.
Yeah, can you speak more to that, the allocation from the investor base? Because that's one thing I was thinking about is where does this money come from, especially as the needs for the vehicles in private credit continue to grow?
Yep. So maybe stepping back, so why is the asset class so attractive to investors? Let's kind of start there, and then we'll talk about where investors source it. So, when we think about it, we kind of think of four pillars of private credit. So the first is there's a very significant illiquidity premium that an investor can capitalize on if they don't have to have daily liquidity or daily trading activity within their portfolio. And importantly, we also think another key premium or pillar of private credit or direct lending is the downside protection you get in the structure. So because we are typically senior secured, top of the cap stack, so when we finance a business, we typically have on average about 35% loan to value. So if it's $1 billion business, on average, we extend a $350 million loan. A lot of downside protection. We have covenants in our structures. We have liens on typically all of the assets of the company. And so you're able to capture this illiquidity premium, but I don't think you're taking on an additional risk premium to do it. I mean, I don't think you're investing in a riskier strategy to garner that illiquidity premium. And then, it's a floating rate asset, which I think for some component of a fixed income bucket, it's nice to have a floating rate structure, just given it's diversifying. So for all those reasons, it's been attractive to investors, including the fact that when you look at the actual performance of the asset class as a whole, it has performed extremely well. In our case, for our hybrid perpetual funds, double-digit returns over a 12-year period, and with very, very low losses. That's a really attractive return for a pension fund, for example. And so that's why it's attractive to investors. So now, where do they source it? It's interesting. Within Bernstein's, there are high net worth financial advisory group. They try to classify assets based on what they're intended to do for your portfolio, not what they're called. It's not equities and credit. It is how much return seeking assets do you have in your portfolio, how much risk reducing, and how much diversifying. And when you think of, direct lending, the potential to achieve double digit type returns, I would argue that's very much a return seeking strategy. But in our case, we've never had a loss in 17 years of doing this as a founding team on an annual basis. And so I'm not going to say it's risk reducing like owning treasuries or cash, but I would say it's a very good risk adjusted return. And because fundamentally the risk investors take in our asset class is credit risk. They're not taking interest rate risk. They're not taking duration risk. They're not taking foreign currency risk, for example. The fundamental risk that an investor is exposed to is credit risk. It's actually very diversifying. There's very little correlation between what's going on with the public equity markets and what's going to occur within our portfolio, for example. So for all those reasons, I actually think investors can source this from a variety of different places within their portfolio. An individual investor, I think, could source it from their equities allocation or their fixed income allocation. Pension plans, institutional investors, some will source it from their hedge fund bucket. Oftentimes it's sourced from a fixed income bucket. But we've actually put a thought leadership piece together which shows the multiples on money that can be achieved if you stay fully invested and reinvest your distributions. We're not arguing that people source it from their private equity bucket, but we think the multiples on that you can earn MOI are really, really competitive versus those other more riskier asset classes.
Can you think about, one of the things I'm hearing about is more and more groups, obviously with great returns across the asset class, more people want to do it. And then also, you hear a little bit about retail access to private equity and private credit funds. What do you say to people, whether it's pension groups or a retail investor looking at their 401k allocation on picking a manager for the private credit asset class?
Sure. So the first thing, deal we do. It's just not the case. We'll compete with a handful. We'll compete with 2 or 3 on an individual deal. And so there's competition, but there's also a lot of differentiation and specialization. And I think there's room to continue to generate target returns for our investors. Now, from an LP perspective, how do you think about selecting managers? And from our perspective, how do you think about differentiation? The first thing I'd say in terms of manager selection, I encourage the LPs to look at the track record over long, long periods of time. In our case, we've been together as a founding team 17 years. We started to invest together in 2008 during the height of the financial crisis. Very few groups have actually been together for that time frame. And that's when, and then I look at that return. But then when you think about differentiation, we think about it across two different dimensions. And the first is execution edge. And then the other dimension is platform alpha or platform advantage. And from the execution edge, for us, this is a blocking and tackling element of our business. It's about recruiting great people, training great people, retaining them. So Austin's a big part of that to us. We retain 95% of our team members since we started this business. And that means we can develop them and we can ingrain them in the way we do direct lending, and we can have a really, really consistent investment process. It's also about, very much in our case, very specialized expertise in a handful of sectors. One of those sectors Marc's the leader of, and it's in our software sector. So we know that sector extremely well. We have an approach that's worked for us, and we've had great track record in that. And we have other sectors as well. I wouldn't want to be a direct lender today and be a generalist trying to be all things to all people. I think another area of differentiation on the execution edge, candidly, is just your market reputation and the relationships with those sponsors. So we lead about 85% of the deals we do in the core middle market. And you don't get in that position if you don't have a great relationship with those sponsors. So that's all blocking and tackling. And I would, if I was an LP looking to allocate, I'd try to put some real tangible metrics around those. However, the private credit manager is saying this is our edge, we'll have them give you tangible metrics that support that edge. Because it's easy to say I'm great in certain sectors, I have a great team, I have a great market reputation, but now let's make it tangible and put some tangible elements around that. And then on the platform side, we feel like we built innovative hybrid perpetual funds that provide a more efficient access to this asset class than other vehicles. Our funds are intended to combine the best features of drawdown and perpetual. And without going into a lot of detail, because it'd be more than we could go through in this call, we feel like this has been what's allowed us to build highly diversified portfolios that we couldn't do if you're managing a drawdown fund, which is where this industry started, which is hugely risk mitigating. And we can finance our portfolios with long-dated, structured finance, middle market CLOs that typically are 10-year, locked-in kind of term finance commitments. And in effect, what we're trying to do is offer our investors the diversity you might start to think of as with a loan mutual fund. It's not quite as diverse, but it's approaching that with a fortress balance sheet so that we know we will never be, and feel confident that we will never be, a forced seller of good assets in a bad market. And so that's kind of our edge. There are other edges out there. So I would just, if you're looking at differentiation, first look at the track record and the performance over long periods, then understand what is it about their investment process, the way they execute and compete day to day, and then see if there's something about the platform as well. Because I think today you have to have a platform edge, and you have to have, the platform has to be part of how you compete. And I think it is in our case.
Yeah, on the relationship with private equity, I think what you're saying makes a lot of sense. Like, you want to invest in private credit funds that are going to get access to the, investment opportunities from the strongest private equity firms. Seems fairly simple. And also, as private equity's reliance on private credit as a financing vehicle increases, their need for that, to come through increases. Can you talk a little bit? I'm reading a lot about continuation vehicles. Sure. Private equity is raising. Like, can you talk a little bit about, discipline, only working with these firms, potentially saying no in that relationship?
It is important that we have great relationships and really strong market reputation and can continue to do business with the sponsors that we want to do business with. And another key metric is how much repeat business are you getting from those sponsors? And we get a significant amount of our deal flow from sponsors that we've done deals with previously. Having said that, one way to do a lot for sponsors is to say yes to everything that they ask for and to just wave in paper. And we don't do that. So we're very disciplined on the opportunities that we pursue. We source about 1,000 deals a year, and we're going to close about 40. So we have about a 4% close rate. And that's important to have a wide funnel. It's also important to be very transparent with your sponsors and make sure that your relationships, make sure they understand you're not trying to be their market share leader necessarily. You're not trying to do every deal for them. You're trying to find the opportunity that fits our investing culture, and then be very aggressive on that and be their best solution or be their quickest solution or use our sector edge to provide them the most certainty. And we want to pick our shots and lean in heavily when we see a great opportunity. And to your point about being able to say no. So, for those that are from Texas, you will know, some may know there's a restaurant called Joe's Crab Shack, and their slogan, if you go up to Joe's Crab Shack, is free crabs tomorrow. And so I always would say to our deal teams, there's a new deal tomorrow. And so there's not one deal that is so important to us that we have to do it to make it work for our business. And having the ability to know that you can turn, it may be a good deal, a good business, but a bad deal. The deal may get too aggressive, and to have the discipline to be able to walk away from that opportunity, knowing there's 5 or 10 more coming in the door tomorrow is really important. And that comes with partnering with a private credit manager or a direct lending manager that has a 20-year history roughly in the business and has a continuous history of operating together as a team and has those relationships.
This is an area where sector edge is really important.
Yep.
And, the reality is we're not going to get there on every deal, but being able to get there quickly and having speed and certainty is really important to maintaining those relationships. We don't want to waste anyone's time if we're not going to do the deal.
Yeah. One of the things that comes up a lot, in the articles about the rise of private credit is this concept of shadow banking. Can you talk a little bit about the term shadow banking and why, groups like the Fed have concerns around it?
Well, shadow banking, I think, just largely, generally, the way I interpret that when I hear that term is it's financing and lending activities that are occurring outside of the regulated banking environment. And so it's interesting because today the Fed is, very focused on, understanding the direct lending market, understanding the private credit market, understanding kind of what is happening outside of the regulated environment. The reality, and we mentioned this when we talked about how the industry accelerated, a lot of this is of the Fed's own making, meaning, the Fed really tried to encourage this type of lending, which they viewed as riskier, to occur outside of the regulated banking system. So you didn't have systematic risk. You didn't have federally insured deposits that were being used to make these types of loans. And in fact, that's what's happened. And you've seen some of that growth. So, but I think it is the Fed is trying to just get comfortable with the fact there's so much activity now and such strong growth that has occurred outside of a market which they have direct oversight with. They're trying to, appropriately understand the linkages to the broader economy. Now, it's interesting, the Fed has come out and said, well, they have concerns and they're focused on this. They have not seen anything to date in the direct lending market that indicates there is systematic risk that's resulted from this. And I would argue that it's less risky for the broader macro environment because, again, you've done what the Fed has, their original objective as part of Dodd-Frank is you've moved some of this lending outside of the regulated banking. And so who holds this paper today? Who holds this risk? They're individuals, certain high net worth, and increasingly retail individuals. Retail has been a new area where you've seen investors allocate to this. But the biggest holders are large, sophisticated investors that understand the risk. So think pension funds, predominantly, also increasingly U.S. insurance companies. And, again, that's who's holding the risk for the most part and outside of the FDIC insured regulated bank. So, but that's what they're concerned about. They're concerned about interconnections. And I will say there are some interconnections. So I mentioned earlier today that it's rare that we would compete in the middle market with a bank, but it is not rare that it is common that banks and insurance companies provide some of the financing that we use to finance our portfolio. So we build highly diversified portfolios, high quality portfolios, top of the cap stack, senior secured, and then we appropriately and thoughtfully finance that portfolio to help optimize returns. That to me seems like a much better way for banks to participate in this market. They're participating in a much less risky part of the capital structure where they have the benefit of cross-collateralization, the benefit of significant equity support. So they're senior in these structures. And so I do think banks have exposure to direct lending. I think that banks have benefited from the growth of direct lending, but they've done it predominantly indirectly, at least in the U.S. middle market.
Look, this topic has been a hot topic in the news lately because of two high-profile bankruptcies, which were Tricolor and First Brands. And, it goes back to our original discussion, which is that the overall umbrella of what private credit is. Private credit, basically encompasses all non-bank lending, and direct lending, like what we do at AB Private Credit is a little bit different, where we're making loans to, market borrowers. The second thing is, by moving these loans outside of a regulated financial institution, there's two key issues and problems for banks. One, banks are highly, highly levered in terms of their capital structure, and the mix of their assets and liabilities is heavily weighted towards short-term liabilities, and these are long-term assets. So they have a fundamental mismatch between the assets on their balance sheet and how they're financing them. And by moving this type of lending activity, specifically direct lending outside of the regulated financial institution, you're actually making financial system systematic.
And just to be clear, Mark alluded to it, but we have no exposure to those two companies that are very much publicized in the news. And it's because we don't operate in that type of market. We're not doing that. That's more of a structured finance, specialty finance type play. Some would argue it may be asset-backed finance, asset-based finance, but it's just not what we do as a direct lender lending to private corporate credit.
Yeah, and it's that story seeing it seems like it's a more efficient model, and in some regards there is more accountability and more sophistication around lending. Like when you guys look at the space, are there specific risks you see or concerns you guys talk about when we see this shift and how it can impact the way we look at our overarching economy or kind of our historic capitalist system in terms of through the lens of the rise of private credit? Who gets capital under what terms?
Yeah, I don't think so, because I go back a little bit to the opening remarks. What is direct lending at its core? It's making private loans to private businesses, and lending to private businesses has been around forever. Prior to the formation of the direct lending industry, it was done with a bank and a junior lender. When I started the private equity in 1996, every buyout that we did, I'd go borrow money from a bank, and then I go find an alternative lender. So effectively what we are today, an alternative lender, and I'd raise junior capital. And so this is very much evolutionary, not revolutionary. The underlying borrowers that they're demanding, that the demand for the capital is getting fulfilled. It's just instead of getting fulfilled by a bank and a junior lender, is direct lender. So if anything, it provides more options for companies, more diversity of lenders. In particular, if you have a view that banks may start to edge back into certain elements of the market. And I think they are trying to do that at the higher end of the market. You hear JP Morgan oftentimes quoted. And so that just gives borrowers more options. So I think in terms of the availability of capital for the broader market, it's good for the economy. Now, over time, if banks really got into that market, and in particular the upper market in a big way, you could see returns come down. And returns are coming down off of the 2023, 2024 peaks. Those levels of returns weren't sustainable. But I still think in the asset class can generate really solid returns relative to a tradable market alternative. So you have a relative value lens, and we still feel really good about being able to deliver on that promise for our investors.
It's seeing and thinking about what the industry will look like over the next 5 or 10 years.
Yeah. So I think, again, in direct lending, I think it is continued growth. We cited $2 trillion. I've seen estimates of close to $3 trillion in the next 4 or 5 years. So I think you'll see continued growth. And I think the insurance industry in particular, you've seen a lot of a lot of increased demand by insurers for what I'd refer to as IG private credit. So this can take a variety of forms. This could be the CLOs I mentioned that banks and insurance companies are financing for us. It could be the senior tranches, specialty finance structures and ABF structures, NAV lending, so lending at a very low LTV to a diversified portfolio, a private equity fund with a diversified portfolio. Those loans, if structured right, can attain an investment grade rating. These are different ways insurers are now really participating in the direct lending market. So I think you'll see a growth of IG now. That growth, I think, almost certainly has to really compete with the bank market because the cost of capital is similar. But I think you'll see some growth in that area as well.
Anything you guys are seeing related to technology or AI impacting the industry?
I think it's probably the hottest topic of the year.
You go to the conferences and it's all AI?
I mean, I was literally at the conference last week, and I think I met with about 20 companies, and everybody's talking about their AI strategy and how they're going to capitalize on AI and so on and so forth. I mean, different segments of the software market are going to be affected differently, whether the use case is, deterministic use case or generative use case, whether the software is core system of record. One of the things that we've been seeing interestingly recently is an ability to take traditional, more services or tech-enabled services businesses and add AI and basically, capture additional margin. So recently invested in a pre-investment background check company that's doing this. And similarly, it's affecting our business in the same way. It's making our investment teams, much more efficient. Whether that's from doing primary research, some of our analysts and associates are using it to check their models and their memos, capitalizing on AI and learning how to use this tool and incorporating our investment process is going to be really key for us in order to be more efficient and deliver for our clients.
So software is a key area of focus of ours. We have tremendous expertise and edge and history in the software market. There's various narratives out there, including some which AI is going to kill software. I think Thoma Bravo recently raised a $30 billion private equity fund focused on software. So you have a lot of tension and different views being expressed. For certain types of software companies, AI can be very, very disruptive. I think we also have a view that unlike when software went through the migration from on-prem to the cloud, incumbents for certain types of software have a real advantage, because the AI tools and techniques can be built into existing software. You don't have to re-architect your entire solution. And that incumbent advantage in terms of just, workflows, processes, customer base, sales, marketing, et cetera, are going to be really powerful. And Marc referenced, businesses that are core systems of record, core workflow management. We think AI in many respects can be a tailwind to the software. The funnel, the lens by which we look at software has narrowed. So because there are certain types of software companies today we probably won't lend to that we might have considered 10 years ago, 7 years ago. But we also don't believe that AI is going to destroy software. We think there's a very, very strong likelihood it's going to to software.
As you alluded to, not only the impact of the portfolio and upcoming deals, but also with the impact it does within your business. You guys have been so gracious with your time. Before I let you go, what's the best way for people to keep up with you and the work you guys do at AB Private Credit Investors?
Yeah, the best way is to follow us on our LinkedIn page. So it's just AB Private Credit Investors. You search that LinkedIn, and Brent and a lot of the team are participating in conferences. We'll post content and material about your deal flow, et cetera. So if you want to learn more, it's a great place to go.
Great. Well, links to both your LinkedIn's and the AB Private Credit LinkedIn in the show notes. Thanks so much for coming on the show.
Thank you so much. Really appreciate it. Thanks for Thank you for giving us the opportunity.
Thank you for listening to Tuesdays and Morrisey. That conversation was with AB Private Credit President Brent Humphries and Managing Director Marc Cooper. What I enjoyed about the episode was discussing private credit as an asset class and how it's changing the way particularly private businesses access capital. If you enjoyed the episode, share it with a friend, and we'll see you here soon. Thanks.